This is Ken Lake with MAC's technical market update for Friday, April 7th. I'm going to start with this soybean corn ratio chart. I've showed it a few other times in the past, but we'll revisit that tonight. You can see that with the current debacle in soybeans and the losses we've seen over the last 4 weeks, we've brought that ratio back to a more normal 2.5 to 1. Back when we set our highs in November, we were closer to 3 to 1. And it was clear at that time that soybeans were definitely the big advantage over corn as far as seedings in 2017. Now, that's changed quite a bit since that November period, and then even from the time in about the 1st of March, we would continue to see this ratio melt down. I don't believe that it's going to change the minds of farmers in the way they go to the field and plant corn or beans. Those decisions have already been made, but it's definitely going to give us some challenges in soybean marketing as we go forward, especially if we see that 6.5 million acre increase in soybeans over previous seedings that USDA is calling for. It's just something to bear in mind and watch. Begin with May corn, and we'll notice that May corn values, just as we thought we were going to see values supported here as stochastics got into a mild uptrend, we quickly collapsed, and we've traded 3 out of the 5 days this week lower, and these values are under pressure. Long-term support will be down here at 350, and really shorter-term support 361 at this 20-day moving average. So we're probably going to track that 20-day moving average for a while until we can get some reason to support this corn thing and go higher. I will also say that Monday will be the first planting progress report we'll see for corn, and we don't expect to see any progress in the Midwest, and we do expect to see southern states progress pretty far advanced over last year, and maybe a little bit ahead of the 5-year average in regards to corn, but it doesn't really matter what the South does when it comes to corn seedings. What really matters is when we get started in southern Illinois, central Indiana, and those areas before we see this thing change much. These corn will look a lot like the May corn contract, showing support at 375, and we're tracking right now the 20-day moving average at 383. Bit of a sell-off here in the momentum, so momentum's going against us going into next week. But the way the weather forecast looks like, we could see a little bit of a planting delay being traded here next week, and would target some higher values here to hedge these corn, maybe back at this 388 or 393 line as far as hedging goes on corn. Soybeans are in a complete meltdown, as I said earlier. Long-term support in the May contract, 934, closed this week here at 942. Fortunately, we do have 2 out of the 5 closes this week higher. Stochastics very oversold, begs for a correction higher. If we do correct, I wouldn't expect this thing to trade above the 20-day moving average, which is 374, until we can get some solid news to trade otherwise. And that the only thing I can predict would be some sort of fund buying spree, which at this point is not being able to be predicted whatsoever. The November beans probably a little weaker than the May bean contracts, simply because it's the new crop contract, and we are expecting the extra production to come in this fall as we seed these extra soybean acres. So long-term support goes back to 908 with risk cleared down to 870. So that's where this is where we should ultimately trade, down around 870, if we see these extra acres seeded, watered, and become harvested come October, November. For now, really 908 becomes a downside target for funds that are going to drive this market lower, and nothing in the foreseeable future that would support soybean values in the November contract. Planning delays, of course, would be bearish for this contract, simply because it would be an idea that we couldn't get in the field to plant corn, but ultimately may plant the beans. So just confirm that those beans would go into the ground on planning delays ideas. Most customers have some hedges in the November contract already completed. For those of you that think you need to catch up, we would advise that you do sell some of these things right here. because our risk does go down another 40 cents to 908 and then ultimately down to 870.